Good morning and welcome to our weekly edition of Ashworth, our weekly market update. We are glad that you joined us and have just a little bit of quick information for you today. As you may know, last week the Fed increased interest rates by 1/4%, and I want to talk about that for just a minute. Before the banking situation that we had a couple of weeks ago, the all intents of the Fed was that it looked like they were going to raise interest rates 0.5% instead of just the 0.25% that they actually did this week. One of the reasons that they're looking at that is that as we get into the banking system a little bit, there has definitely been some pressure put on some of the banking systems. They are healthy, they are strong for all intents and purposes. That's not the major concern. But where the concern lies with the Fed is that with the banks in the situation that they're going to be in, they probably are not going to be lending as much as they have in the past. There's just some restrictive nature of that that's going forward. And so one of the things that the Fed did as they were considering their interest rate hike is that even though, in their words, they can't measure how much restriction that the banking system or the things that are happening in the banking system would have produced from a restrictive standpoint, they don't know, but they did back down on the interest rates a little bit. So right now we're at 4.75 to 5%, and that is restrictive, and we see things slowing down in the economy in a number of different areas. And the Fed was actually a little bit more soft in their tone this last time when they spoke than they have been over the last year. And we're saying that at some point that they see that potentially that they can stop raising or at least do a pause on the interest rates, and hopefully at some point if the economy starts going down, they do have the capacity now to lower interest rates, whereas when they had the interest rates at zero, there was no place to go down. So for all intents and purposes, things are working through the markets as we anticipated that they would. We have had volatility in the market as we anticipated that they would. Interestingly enough, last week was a real volatile week. We had up days, we had down days of some fairly big magnitude, but for the week ending, we actually ended positive for the week on the S&P 500. So things are working through. We anticipate continued volatility. But one of the things that I want to point out is as we come here, anytime that we've had a tightening cycle, and you can see here on this year by year by year, what the tightening cycles have been, or when the Fed has tightened interest rates, and then the following 12-month equity return beyond that point. So you can see 23% for this cycle, 10% for this cycle, 35.5%. This was 2000 when we had the tech bubble. So it was actually a negative, but it's the only negative that we've had in the marketplace after 12 months after a tightened cycle. And the average you can see here is about 17.6. So it's just kind of the way that the market works. Anytime that the market sees that we're healing from an economic situation, the market likes to get in front of it, not behind it. And it's kind of a fear of missing out mentality. And so the dollars come rushing into the market fairly quickly once that they see that the market is stabilizing. And so it's an anticipatory return even before the market has fully recovered, or even if we have a recession, even before the economy starts coming out of recession. Many times we'll see these types of anticipatory returns in the marketplace. And so as we look forward, we do feel like that the markets are going to continue to heal. We do feel like that we're going to continue to have volatility in the market. And taking a sidebar step here, looking at bonds, we actually think that the bonds may do well as well. So a mixed portfolio of both stocks and bonds. Last year, both did very poorly. This year, we anticipate that even the bond market is probably going to do fairly well this year. And the reason for that is that on the bonds, the shorter term bonds, as they mature, those monies are paid back to the investors, and then they have to be reinvested back again. And in those reinvestments now, instead of buying in at coupons at 1% and 2% like we were at the beginning of last year. We're now buying in at coupons at 4.5% to 5%. So even just that base rate should provide a fairly good tailwind for bonds. And then if the Fed, or when the Fed decides that they're going to reduce interest rates, or maybe pause, or take a look at softening the interest rates at all, you'll see the principal amounts actually increase above and beyond that 4 to 5% of the coupons, just because of the falling interest rates. So again, we just move forward. We let the markets kind of do their thing. We try to invest in the best way to help you accomplish your goals. And sometimes we have to take a little bit of volatility just to offset inflation a little bit. So with that, we're going to close it up for today. Thank you so much for watching. And again, if you have friends, family, associates, coworkers, etc., that you would like or think they would like to view our webinar, please feel free to forward on our link. Thank you so much. Have a great week, and we will see you next week.